Thank you so much, everybody, for having us here today, and apologies for getting in between the snacks. So actually, I arrived yesterday in Poland with my colleague, Nicole Chong, and it's both of our first times in Poland, and the weather was incredible. It was sunny, it was beautiful and warm. I'm like, what a lovely experience. So I woke up this morning somewhat disappointed, admittedly, but I guess it's like these markets, right? We have to be prepared for any kind of conditions, and you really have to kind of have your portfolio allocations in the same way, thinking about how to brace for potential storms. And hopefully today we'll bring some of that market flavor to what has already been quite a robust discussion. So as was mentioned, I am coming from BlackRock, and I think it was quite interesting what Eva said in her presentation just about the increasing adoption of ETFs over recent years. And it's been interesting speaking with our own team here just how much our commitment is to the Polish market. We've been the first movers in this market, and as well, we're continuing to have very strong commitment. So turning to markets. So gauging by the amount of sleep that myself and my team had over the first quarter, certainly a challenging time for investors to navigate. Now, we really see this as what we call the end of the great moderation playing out. Okay, so what exactly do we mean by this? Well, BlackRock made a call last July that essentially declaring that we are entering a new macro regime, one that will be marked by high inflation and high macro volatility. So essentially, 4 decades of low volatility, low inflation has now come to an end. And so that does really require a different way of thinking about investing. And we call this the new investment playbook. So looking at what has happened in markets in the first quarter, we can see that this new regime is playing out in the sense that inflation is surprising to the upside. We have seen forecasters continue to revise their expectations for price growth higher, all at the same time that we are seeing economic growth become more challenged. So essentially, we do see central banks as really trying to fight this inflationary backdrop by aggressively tightening monetary policy to such an extent that we do expect we will see recessions in the US and Europe later this year. So how does one really prepare in this type of environment with tactical asset allocation? So earlier, maybe about a month or so ago, I do recall that our team was exceptionally busy, and certainly at BlackRock, in kind of helping our clients navigate what turned out to be quite significant banking turmoil. We had idiosyncratic events in Europe as well as in the US regional banks. And ultimately, this does add to our view that we are seeing a material tightening in financial conditions to such an extent, actually, that it probably alleviates some of the pressure on central banks to continue to raise their policy rates as aggressively as what we had expected earlier this year. So the fact that previously we did think the Fed, the ECB would raise their rates quite aggressively to create these downturns, now we expect the Fed is likely going to have one more rate hike and then pause as they assess the impact of their earlier rate hikes, notably because the banking stress is contributing to this tightening in financial conditions. So that is really kind of underpinning our view that a US recession is going to come through. So what are some trends that we're seeing come through on the back of this from investors? Well, probably the most notable has been the increase in money market funds. Now, this has largely been supported by deposit outflows from banks because you can really get higher yields in sitting in these cash-like exposures. So if you're an investor and you're looking at essentially all of this cash on the sidelines, what does it mean for allocation? So in our view, we do think that eventually, once we see key signs of kind of a positive economic backdrop emerging, more clarity coming from policymakers, that there's a lot of cash to be deployed on the sidelines. So that is clearly what we're watching for. It's just signs of some risk-on sentiment coming through. Now, in talks about, okay, so what are those key signposts? How can really gauge what investors are thinking? And I think a really interesting dynamic of the ETF landscape is that it provides a great proxy for broader investor sentiment. And there are quite a few interesting trends that are emerging when we look at ETF flows. So a couple do stand out that I wanted to highlight. So the first, I mentioned the banking turmoil that we saw in the US. A key trend that emerged from that is we saw investors allocate a record amount to ETF fixed income, notably rates, through that period in March. So ETFs are really providing that liquidity in times of market turmoil. Then another interesting trend in looking at broader investor positioning is we did actually see investors, yes, they were seeking those kind of defensive, safe haven type of plays, notably in US Treasuries, given the rate space, but they were actually seeking some kind of riskier allocations outside of the US. And the most prominent trend was actually their exposure to emerging markets. So we see in Q1, we actually had a record amount of inflows from global investors into the EM equity space. And as well, we did see that was largely underpinned by the China reopening, which has been mentioned before, just the robustness that is coming through on that front. Now, sectors are another way that we see clients leverage ETFs to try to get that tactical exposure. So we saw, for example, healthcare was more challenged, energy, but we are seeing technology, given that safe haven type of dynamics. Investors are really quite attractive still to that sector. So we had technology have the strongest inflows since about October of last year. So we are seeing, despite this exceptional market uncertainty, there are areas where we are continuing to see chasing the money in these key areas. So then, kind of taking stock of so far this year, if we think about, okay, well that's kind of hindsight, how do we look about the market conditions and how to position going forward? So at BlackRock, we really break this down into three key themes. The first is around pricing the damage. So as I mentioned, we do expect that central banks have tightened monetary policy to such an extent that that will trigger recessions this year. But yet, when we look at equities, I mean, the S&P 500 is up 8% this year. The NASDAQ is up 15%. But yet, we have a recession looming. So clearly, there's this disconnect that we do think equities are not accurately pricing in that economic damage. Second, given central banks have raised rates to levels that we really haven't seen in a number of years, certainly in my career, really the fact that bonds are back because they are providing this quite attractive income given where yields are. And then finally, this whole macro regime change around the fact that we do think that we are living with a higher degree of inflation. So at BlackRock, we expect that inflation in the US, for example, will settle at levels well above those pre-pandemic levels. So it's about positioning for this. So how do we position in this uncertain macro environment, in this environment where central banks have raised rates, where we don't have great clarity on the growth path going forward, and certainly inflation continues to surprise? Well, we're underweight developed market equities. Now, this was a view that we took last July, and yes, it is still our tactical asset allocation, largely because we think that, as I mentioned, earnings are not accurately pricing in the damage yet to come. So looking at earnings estimates for 2023 for the S&P 500, it's about 0.7%. So that's still positive for the calendar year, despite the fact that we see a mild recession come through in the US. So if we look at previous downturns, we can see anywhere from profit recessions up to 30%, 10%. We're not expecting that degree of contraction, notably because the US economy is starting from a level of relative strength. But we do think that there is significant room for earnings downgrades in the latter half of the year. That keeps us quite cautious on the broader developed market equity space. So where do we have high conviction views? Where are we seeing investors put money, and where are we putting our own money in this uncertain environment? Well, as I mentioned in Q1, we saw significant flows into emerging market equities. And we actually went overweight emerging market equities earlier this year. Now, that was largely underpinned by the China reopening. So the China reopening has come in faster than expected, sooner than expected. We do expect growth in China could have a 6% or even a 7% handle so far coming through this year. And so that is being captured in terms of our equity exposure. And we do think that is going to have spillover effects to the broader EM landscape as well. Now, it's not just the equity sleeve that we do like, in particular because, as the chart on the right shows, we can see that actually earnings are expected to be more upbeat in emerging markets. So they're not going to face the same headwinds as we think the developed markets will. Now, EM debt is something that we are starting to see investors allocate to as well. In fact, in April so far this year, we have seen local currency EM debt, along with some high yield, start to gain investor interest once again. Now, this is largely because central banks in emerging markets are much further along in their tightening cycles, and they're more likely to cut rates, provide a little bit of that capital uplift, rather than continue to keep policy rates restrictive. And then as well, if we think about kind of the big behemoth for emerging markets, the US dollar, we do think the US dollar peaked earlier this year, and one of our key convictions is that we are going to see dollar weakness through the end of the year. So then, how does this translate into our other asset allocation views? Well, as I mentioned, we're looking at the ways investors are positioning in flows in the sector space. So we do have a couple of key conviction areas that are more tactical in nature in terms of how we're seeing investors use ETFs in this space. So healthcare remains a key conviction area for us. Now, largely because we do think it's going to benefit from the short-term demand that's still coming through post-pandemic, but as well, if we think about the long-term demand. I mean, I know I'm getting older. I certainly feel it more these days. I know aging populations as a whole is really going to be a key challenge. We're going to demand more healthcare. So we think that that's key structural support for the sector. As well, technology. So technology has really, tech stocks have really been the powerhouse of equity markets year to date. While we think they're going to be challenged more in the near term, we do think that equities in the tech space still are an attractive tactical play if we look at the 12 to 18-month perspective, largely because these are still profitable secular growers, but it's really about taking a very granular approach to the tech space. So looking at the high-quality, pure tech plays, rather than just looking at the broad mega-cap spaces, where really the valuations perhaps aren't justified from a tactical perspective at this time. So then we talked about equities. I think really crucially what we're seeing come through, as we saw in the first quarter of fixed income ETFs really marking a record quarter, is the fact that bonds are back. And it's still ingrained in my brain when our head of fixed income in London paraded around the floor saying, bonds are back, bonds are back. So now everybody on the floor has a mug that says bonds are back, and it's pretty much our daily slogan. So it really just captures the change in environment that we have now for fixed income investors. So we do like short duration credit. That was pretty much a key conviction call across the street earlier this year. But we are still kind of having strong conviction in that. Probably the key area where we're an outlier in terms of consensus is we're actually underweight duration. So yes, we expect a US recession to come through, but we're not actually buying bonds at the longer end of the curve for a ballast. Well, why is this? Well, if we think about this time is different, the famous phrase, and an excellent book, but ultimately, if we think about this is a higher inflation regime. We expect inflation in the US to settle around that 3% to 3.5% mark. So investors are likely going to demand that higher term premium to hold that longer end fixed income. And as well, I think markets may be misreading this current business cycle. So in contrast to previous business cycles where, okay, yes, we see a recession, what does the Fed do? They cut interest rates by about 300 basis points. That's not our view this time around. If anything, we think they're going to keep rates in restrictive territory through the end of the year. So we're not going to get that same dynamic that typically would support fixed income. But as I mentioned, you can get quite attractive income at the front end of the curve or even the belly end of the curve. And we are seeing quite a number of investors really take those tactical plays, leveraging ETFs in this type of space because of its liquidity properties. And then if we think about other areas of fixed income where we are seeing tactical opportunities, I mentioned short duration credit was a key area earlier this year. That trend is largely played out in our view. We are still seeing attractive opportunities in Europe though, largely from a valuation perspective. So European investment grade at the front end, the short duration, we still think is quite attractive. If we look at what's implied by spreads from kind of the recessionary perspective, we think a recession in Europe is largely priced in. Now in Europe, for the ECB, we expect they're going to actually continue to raise rates beyond the Fed. And given the fact that inflation continues to surprise to the upside, notably that core inflation, we do think that that actually tilts the risks in Europe towards that greater degree of tightening, but we think that's largely in the price. So you can get that high quality spreads without necessarily taking on the duration risk. So that is, again, an area where we are seeing quite tactical opportunities play out. Now, I mentioned inflation, new regime, and people often say, Laura, you're calling for this new inflation regime. Why all of a sudden, after central banks struggled to get inflation anywhere near their 2% targets or above for such a prolonged period of time, why really is this time different? And it largely comes down to three key themes. One, as I mentioned, aging demographics. A key trend that we saw from the pandemic is that a lot of workers essentially left the workforce. So we saw a structural shift in labor force participation rates. So we don't think that's going to resume, and if anything, we think that's going to keep pressure on wages. Then geopolitical fragmentation. We are thinking that now is the time where fragmentation is the highest that it's been since just after the Second World War. So the rewiring of supply chains, we think that's going to be inflationary as well. And then as well discussed by Mobeen, just the commodity complex, this transition to net zero. He had a great chart with all of the kind of supply-demand dynamics and the shortages there. We think that's another, really the third pillar of what's going to drive this inflationary backdrop over time. So from an investment perspective, we don't think that medium-term inflation expectations are accurately pricing that risk in. So 10-year break-evens in the US, even 5-year swaps, pricing in about 2.5% long-term inflation. That's well below our expectation. So there is significant upside, we think, still in getting this type of inflation protection. And then finally, what was talked about quite extensively by Mobeen as well is around gold. And I think he talked about kind of the macro fundamentals of it and the underpinnings of why to be bullish on the commodity, which we largely agree with. I think an additional layer, though, we can provide is looking at the flow space. So what's been most interesting is that April so far, almost May, not quite, but so far in April, we have actually seen investors really renew their allocations to gold by the most that we've seen in more than a year. So it does suggest to us that, okay, are investors actually thinking that gold is going to have another renewed rally above 2,000? Maybe not, But what we are seeing is that investors are closing out excuse me, their underweight positions that they've held through 2021 and 2022. And as well, it's really about taking on that safe haven type of exposure. So we saw that in terms of the rates profiles with US Treasuries, but it's clearly coming through in gold. And when we talk to clients, we say, what's kind of your thesis behind gold now? And it's really about taking on that diversification exposure. If we were to see a tail risk event coming from geopolitics or coming from inflation upside surprise or a steeper recession than perhaps markets are expecting in the US and Europe, they want to have this allocation to this kind of this real asset in gold. So that's really what's driving our view that you continue to need to have this type of exposure going forward. And then, so this is a very busy slide from those in the audience. I appreciate it's probably not the most user-friendly in this format, but it really does capture all of the different tactical asset allocation views that we do have. Now, the ones that I mentioned that are more recent are around our overweight to emerging markets. We do like inflation-linked bonds, and as well, EM local currency debt. So ETFs really provide this additional kind of a product for clients to be able to try to capture these different trends. So the key question I'm often asked is, okay, this is great, but what are the key guideposts you're watching in terms of actually changing these tactical asset allocation views? So I sit on our EMEA Tactical Asset Allocation Committee, along with Nicole Chong, my colleague in the back. And so some key guideposts that we're watching for now, one is around policy clarity. We really need to have some guidance, whether it's from the Fed or the European Central Bank, around when they expect to end their tightening cycles. As well, we're watching for signs of inflation. We had last week's final CPI prints from Europe. We had UK inflation that really strongly surprised to the upside. So we're yet to see meaningful signs of easing in this space, which does tilt the risk towards central banks having to tighten even further. So we really need to see some clarity from policymakers. Third is around sentiment and positioning. We are seeing US Treasury shorts, for example, in the 10-year, be exceptionally large. Are we seeing signs of a turnaround in terms of how investors are actually positioned? We're starting to see some signs of that in European equities, where we are seeing US buyers ease up their pace of European buying, which is an interesting trend because Europe has outperformed the US for a prolonged period of time. So the first sign of that kind of buying ebbing tends to be when we see US equity outperformance over Europe. So we're watching that sentiment and positioning quite closely. And then third, we're watching the economic data. I mean, much like central banks on a meeting-by-meeting basis, arguably our TAA is on a meeting-by-meeting basis, because we're watching for labor market deterioration, we're watching for softness in the US labor market in particular, because we think that will be a key guidepost to easing inflation going forward. But that's it from my perspective. Hopefully it's sunny. I leave tomorrow, but hopefully it's sunny for you on the weekend. But more than happy to take any questions if there are any. Or as well, Nicole Chong is my colleague if there's a coffee break after for questions. Yes?
Hi, Krzysztof Stopnicy. I used to be Chief Investment Officer for AIG, MetLife, and ING. Now, the one question. If we look at your macro analysis in the first part of your presentation, that was very logical. However, if I look at the tactical asset allocation, which is for 6 to 12 months, if we look back for the last 3 months, the markets, particularly the equity markets, have performed completely the other way around.
It's been a pain trade for us, yes.
Yeah. And on the fixed income side, it's more or less the same, the short-term versus long-term treasuries. So how would you explain that? Do you have sort of off-record or on-record explanation what went wrong with this analysis or recommendations for asset allocation.
Yes. It's actually interesting because I wrote a piece in the Financial Times exactly covering this, in the sense that what we looked at from a positioning perspective, the rally that we saw before the banking crisis was actually largely a short squeeze in US equities. So investors were exceptionally short. We saw a couple of catalysts around that, notably from options expiries were quite robust. That really led to that. I think from now, though, since then, through the banking turmoil, it's largely been easing expectations coming through for the Fed. We had as much as 100 basis points of rate cuts priced in for the US in the back half of this year. And that, in turn, in our view, likely propelled the long duration proxy type stocks like tech to lead overall gains. So the fact that we have seen some of that price out, we think is not enough. We think that there's even more scope for about those 50 basis points of cuts in the year, by the year end, to be priced out even more. So we do think that's going to be, one, the key trend to watch for from an equity perspective, and as well earnings. So earnings so far this year, in this quarter, have been exceptionally robust, but from a beat perspective, largely because over the past 6 months, we've seen significant downgrades come through, so it's quite a low bar to beat. If we start to look at the key trends emerging this season around margin erosion, around deterioration in consumer demand, we think those are going to pick up more materially in Q2 and Q3, enough that investors will start to really challenge the valuations that we are seeing in equities right now. Happy to discuss this afterwards, because I'm curious for your thoughts as well, but yes.
Any other questions to Laura?
Hi, Jarosław Przybył, Alio Bank. I have a question regarding financial sector, because I had an impression they were overweighting financials. What do you think might be the impact of the exposure of US and European banks to commercial real estate, and also the outflow of deposits, or from deposits into money markets, particularly in the US? Do you think it might impact the earnings of the financial sector?
Yeah, this is a key question. In fact, we had our global investment strategy group team call this week, and that was kind of the key thing that our CIO focused on. So if we actually strip it down, looking at commercial real estate as a broader sector of total bank non-financial liabilities, it's actually only around 12 to 15%. So we don't think that it's going to be a material impact in the broader lending space. But so far, we expect that the tightening in lending conditions that could come on the back of that is equated to about 25 to 50 basis points of rate hikes. So at this point, we think it's going to be fairly contained, just already feeding through in the tighter financial conditions. But we don't think we're going to see material defaults within the space that would prompt kind of a broader credit crunch that we saw previously. And then the deposit outflow, I mean, it's something that we're monitoring quite closely. I think our US bank analysts are tracking that. I don't know, Nicole, maybe if you've been, no? Yeah, so if anything, what came through in the US bank earnings last week was the fact that these large banks are the net beneficiaries of that. So the broader banking space, we think, is not going to be as impacted. Probably the key things we're watching for are, we expect greater regulation to come in, so higher capital ratios to come through in these banks. And we do expect more collapses of US small and potentially regional banks. But we think there's going to be that's going to be contained from a broader contagion perspective.
Anybody else? Thanks so much, Laura. Super interesting.